So, what if a country's economic collapse wasn't an accident? What if it was all part of a plan? Today, we're going to break down a pretty wild theory about Japan's economy, one that suggests its apparent self destruction might actually be a calculated global scale move with huge consequences for all of us. All right, so let's jump right into the big puzzle here. For decades, it seems like every time Japan even whispers about changing its interest rates, the entire world freaks out. So why does a single decision in Tokyo send Wall Street and London into a total tailspin? Well, the answer starts with a really simple but incredibly powerful idea. The story really starts right here. For years and years, Japan basically became the planet's personal ATM machine. By keeping its interest rates at practically zero, it unleashed a fire hose of cheap cash onto the world. You want to borrow money? Borrowing from Japan was almost free. And that created a massive opportunity for investors everywhere. And this led to one of the most popular investment games on Earth, the carry trade. Honestly, the idea is super simple. You borrow Japanese yen for next to nothing, you swap it for US dollars, and then you buy something safe that pays you, like a US Treasury bond that's paying, say, 4 or 5% interest. You just get to pocket the difference. It was a money-making machine, pure and simple, all powered by Japan's cheap yen. Okay, now this is where things get really interesting. If you look back, you start to see this weird pattern emerge. When Japan decides to turn off that spigot of free money and actually raise its rates, global markets seem to have a meltdown. Think about it, the dot-com bust, the 2008 financial crisis. The theory we're digging into today argues that the seeds of these massive global events were actually planted with a small rate hike in Japan. And the amount of money we're talking about here is just, it's mind-boggling. This isn't some small niche strategy. We're talking about an estimated $20 trillion wrapped up in this carry trade. To give you some perspective, that's about a fifth of the entire global economy, all of it balancing on the foundation of cheap Japanese yen. So you have to ask, if raising rates causes all this chaos, why on earth is Japan doing it now? Well, the official story is pretty straightforward. They're trying to fight inflation. But the theory we're exploring asks a really important question. Are they actually fighting the right fire? Or is that official story just a smokescreen for something else entirely? And this slide right here lays out the two competing stories perfectly. On one side, you've got the official line. Japan has a classic domestic inflation problem. People are spending too much, so you got to raise rates to cool things down. But the other theory says, no. The problem isn't inside Japan at all. The problem is that the yen is weak, which is making everything Japan has to import crazy expensive. This gets us to a really critical idea, this concept of imported inflation. Understanding this is basically the key to unlocking what could really be going on with Japan's whole strategy. It's actually pretty simple when you break it down. If the yen gets weaker against the dollar, it just means you need more yen to buy the same barrel of oil or the same shipment of food from another country. So this theory argues Japan isn't creating its own inflation because people are on a spending spree. It's literally importing inflation from the rest of the world, all because its currency is too weak. And the proof, according to the source, is in the pudding, or in this case, the ramen. For decades, even when the Bank of Japan was printing mountains of cash, the prices for local stuff, like a simple bowl of ramen, they just didn't budge. That suggests all that new money wasn't actually causing prices to go up inside Japan itself. Okay, so if raising interest rates is the wrong move, if it hurts Japanese businesses but doesn't fix the weak yen, then this theory says Japan has a much more powerful weapon it could be using. A weapon that it seems to be keeping locked away on purpose. So how would that work? Well, the logic is super direct. If your currency is too weak, you need to make people want it more. So how do you do that? Japan could sell off some of its huge pile of US Treasury bonds, get a ton of US dollars, and then use those dollars to go buy up yen in the market. That huge demand would make the yen stronger. Simple. And make no mistake, Japan has the firepower to do this. It is the single biggest foreign owner of US debt in the entire world. We're talking over $1 trillion worth. This isn't just some small policy tweak. This is a weapon of immense global financial power. And here's the kicker. This isn't just a hypothetical idea. The source points out that Japan has already done this exact thing before, and it worked. Back in 2014, and then again in 2022, the yen got weak, so they sold some treasuries and the currency stabilized. But, and this is the really weird part, right now, with the yen weak again, they're doing the complete opposite. They're actually buying more US bonds. And that is the absolute core of the mystery. Their actions seem totally backwards. almost like they're trying to hurt themselves. Why would they do that? It makes you wonder, what if hurting themselves is exactly the point? This is where the theory goes from being an economic puzzle to something that sounds more like a conspiracy thriller. It lays out what it claims is a shocking three-step plan to engineer a controlled demolition of its own economy, all to reshape the entire global financial order. The theory breaks it down into 3 acts. Act 1 is nurturing. For decades, Japan lends cheap money to the world and uses the profits to buy up real stuff. Mines, farms, factories, you name it. Act 2, detonation. Japan deliberately pulls the trigger, raising rates to spark a crisis at home. And finally, Act 3, the harvest. The crisis forces Japan to sell off all those global assets for pennies on the dollar. So, if this is really a controlled demolition, you have to ask the most important question of all. Who gets to pick through the rubble? And that brings us to the supposed endgame of this whole thing, the global harvest. The theory wraps up with this incredible sequence of events. Japan is supposedly forced to sell its trillion-dollar bond portfolio back to the US, but at a huge loss, basically giving America hundreds of billions of dollars for free. Wall Street, now swimming in all this cheap cash, then swoops in and buys up Japan's real-world global empire, all those mines and factories, for bargain basement prices. It's a gigantic, cyclical transfer of real wealth from east to west. So in this version of events, Japan isn't a country in decline. It's a critical part of a recurring global reset button, a coordinated play where real-world wealth is systematically moved from one pocket to another, with Japan acting as the trigger for the whole cycle. And that's the big, provocative question this whole theory leaves us with. Is Japan a victim of its own bad policies stumbling toward collapse? Or is it a willing partner in a global game that's far bigger and far more complex than most of us could ever imagine? The answer could end up defining the next decade for the entire world economy.